So that is part of, you asked, what's the state of the economy? The state of the economy is that it's slowing down, slowly deteriorating, and will end up facing a recession, as we always have had when you have monetary contractions.
Despite official economic data showing a strong labor market and a decline in inflation, U.S. consumers suspect that there may be more to the story, as the Federal Reserve cuts rates just in time for the big event in November, and the latest jobs report beats all expectations despite rising layoffs. U.S. economic growth is expected to fall behind that of China and India. So what is really going on here? I will discuss these and other important questions with my guest. I'm very excited to have an opportunity to connect with Dr. Steve Hanke, a well-known American economist. He's a professor of applied economics and founder and co-director of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise at the Johns Hopkins University in Baltimore. Professor Hanke has been one of my go-to experts on economic updates and analysis. He has a vast following on X, so make sure that you give him a follow there to stay updated. Let's dive into the conversation. Hello, everyone. I'm very excited to welcome Professor Steve Hanke. Professor, it's so great to see you. Thank you for taking the time.
Good to be with you, Lena.
Great to have you. I'm very excited about this opportunity to connect with you. Professor, I've been following your work and your recent interviews. They have been so incredibly helpful in trying to, make sense of the world that we're living in today with the official data and reality not always exactly aligning. So to start us off, I know our viewers would love to hear your perspective, maybe from a macro point of view, to start with, on the state of the U.S. economy at the moment. Jerome Powell just said that inflation is moving towards the 2% target rate. The Federal Reserve cut rates quite aggressively, and it plans to do so once again before the end of the year. Powell also said the labor market is strong and his monetary policies are still on track to possibly hit that soft landing. Could you share with us your thoughts on the state of the U.S. economy today?
Well, first of all, before I do that, let me just make a remark about Powell. Powell is basically spinning a tale, and this tale is that he's a hero and that the Federal Reserve is doing everything right. In fact, Powell has been a complete disaster under his leadership. And what did the Fed do? COVID hit in February of 2020. The Fed hit the accelerator and the money supply zoomed up. And in February of 2021, it hit an all-time high of around 27% year-over-year growth. So that's the highest since 1913 when the Fed was established. And sure enough, we got, with a lag, inflation. And that inflation peaked out at 9.1% in July of 2022. It's just something that John Greenwood and I predicted. And why did we predict it? Because we're monetarists. And monetarists focus on changes in the money supply because those changes, with a lag, will cause changes in asset prices, change in economic activity, and ultimately changes in inflation. So that was kind of the upside. And then the Fed started throwing things into reverse. And the money supply has actually been contracting since July of 2022. That has only happened 4 times historically. If we go back to 1948-49, there was a contraction. 37-38, there was a contraction. And then, of course, 1929-1933, there was a huge contraction. We had a Great Depression. And 1922. So you have to go way back in history to even find these contractions. And they always lead to a recession. So that is part of, you asked, what's the state of the economy? The state of the economy is that it's slowing down, slowly deteriorating, and will end up facing a recession, as we always have had when you have monetary contractions. Now, as far as the inflation goes, John Greenwood and I predicted that it would go up. We said to 9%. It actually went up to 9.1%. We now say that by the end of this year, it'll be 2.5 to 3%. Well, it's already 2.5. And we say that next year it'll probably go below 2%. That's due to the contraction in the money supply. This contraction, and with a lag, you get these economic effects. So that's kind of the state of the economy. And the money supply now, by the way, is growing at around 2% year over year. And it should be growing if it was growing at a rate consistent with the inflation target of 2%. It should be growing at Hanke's golden growth rate, 6%. It's growing at about 2%. And there has been this contraction. The stock of money is actually less now than it was back in July of 2022. So that's a thumbnail sketch of things. Powell is just spinning. He's a spin meister. And your introduction is exactly what he's been saying, which is basically what? I'm wearing a halo. I'm doing everything right. We're conquering inflation. Well, he forgets to tell us he created inflation. And the big problem with the Fed, by the way, the reason the money supply went zooming up and then zooming down and is giving us this volatility is the fact that the Fed doesn't pay any attention to the money supply. Powell has said this, by the way, in testimony. A week or so ago, official at the New York Fed, someone asked what he thought about the contraction in the money supply. And he said, "Oh, we don't even pay any attention." He said, "I don't even pay any attention to the money supply."
It's incredible. One of the things that Jerome Powell loves to sort of point to is the strength of the labor market. And we had a really interesting report that was released yesterday. The most recent September jobs report was widely celebrated on the mainstream media. They said it's a sign of a very strong economic activity, growth. And according to the Bureau of Labor Statistics, the US economy added 254,000 jobs, with unemployment slightly decreasing from 4.2, as you mentioned, to 4.1%. So to me, it almost looks too good to be true, considering we've had downward revisions virtually on a monthly basis. What is your take on the latest, quite surprising, in my personal opinion, jobs numbers? And do you expect another round of downward revisions at year end or in early 2025?
So I expect the report was strong, and as you point out, we've had huge downward revisions in the past few months. One of them, remember that one whacked off 800,000 jobs in one revision, a little over 800,000. But so I kind of have a couple reactions. One is that it seems to be very opportune that it's happening right before the election. So, and given the fact that they're revising these numbers all the time, the numbers seem to be a little bit fuzzy. Let's put it that way. So, the first glimpse we get at them is one thing, and then there are always two or maybe even three revisions going forward. So, I expect that they'll be revised down, but it's not going to happen until after the election. The establishment is the establishment, and they defend the establishment, and I have grave suspicions about the veracity of these employment data.
It'll be really interesting to see what the next month and the year-end data shows. I think that's something to look forward to, just to see whether there's another revision and what other data shows in the context of what you just said, the US economic decline. In a recent post on X, you mentioned that you do expect to see a technical recession in the United States. Many people would argue that we have already been in a recession, although we know that they changed the roughly speaking formula, the way that it's presented, calculated. Could you elaborate on that and explain whether you believe it would be a short-term economic downturn and how severe would you expect it to be?
Well, one thing there is a lot of debate on defining what a recession is. I mean, if you go back, for example, one definition that John Maynard Keynes put forward in the general theory was if you're growing at less than your potential, Keynes defined that in kind of a generic way as being in a recession. So that's one way. And then there's some people say, well, if you have two successive quarters where GDP is negative, that's a recession. My own view, and I think probably the most reliable one, I just go with the National Bureau of NBER data, and the NBER, they really define the recession, including a lot of factors. In other words, it's not just GDP, it's what's going on in the labor market, the financial market, and so forth. They have an expert group at the NBER and National Bureau of Economic Research up in Boston. And if you go to their website, all the recessions we've had, they define them. So I think that's the most reliable thing, and most economists go with that. I do, and I do think that we will have an NBER indication that we've had a recession sometime in 2025 due to this monetary contraction. And I should mention, Lena, you said that the labor market's strong and so forth. Well, if you look at the unemployment rate, it's actually gone up 0.7% since the low, and there's some people that indicate and measure recessions by changes in that unemployment rate, and if it's over 0.5%, they say we're in a recession. So, using that metric, we're in a recession. You see. So there are just all kinds of ways to measure this, all kinds of metrics and so forth. I just go with the NBER. It's the most broad-based and I think the most credible and reliable. But at any rate, let me summarize by saying, what's all this mean for your viewers? It means no matter how you define it, things are going to slow down.
2025 is promising to be a very interesting year. There is so much uncertainty, and with economic growth slowing, I think our viewers really need to start paying attention to the latest data and try to seek out knowledge and experts such as yourself to help them interpret that data. What I really want to get your...
Now, Lena, on that's an important point you're making here. Your viewers should understand what you just said is something they call data dependency. So you look at all the data that every week there's some new piece of data that comes out. And of course, the financial markets are in gear 24/7. So you're getting data about exchange rates, interest rates, in real time. That's data dependency. Now, the problem with that is that data that you're looking at today, the cause of that is due to the fact that there have been changes in the money supply that happened a year and a half ago, maybe 2 years ago. So it's changes in the money supply that one has to focus on, and I focus on it because I am a monetarist. And the macroeconomy, think of it this way: the fuel for the macroeconomy is what? Money. And if you change the rate at which you're injecting fuel into the economy, you're going to change the speed of the economy. It's just like a car engine. But the problem is, for most people, there's this big lag between changes in the money supply and changes in asset prices, then changes in the economic activity, then changes in inflation. So they have trouble because they're reading the daily press, and they're getting their feet all tangled up and confused because, as you say, the labor market, we just got a Friday number. It was strong. There's no question about it. Well, maybe that's going to be revised later. And maybe the next month's data are not going to be that good. But the trend will be down, weakness. And the reason for that weakness will be what has happened to the money supply. As I said, since July of 2022, the money supply is actually contracted. So the fuel in the tank is lower than it was in July of 2022. So I'd put it this way: we're kind of running on fumes.
It's so helpful to hear you explain that because very often we focus on interest rates, right? As, oh, is the Fed going to cut interest rates? And then that's what everybody's focusing on. But just as you mentioned, we're not paying enough attention to the money supply. And so I'm really, really grateful to you for pointing that out because I know that our viewers will appreciate learning that. It's a very important point to make, and hopefully that will be one of the key takeaways for our viewers from this conversation. I would like to quickly switch to economic policy and specifically trade policies. We're just several weeks away from the big event in November from the elections, and both presidential candidates appear to back or to support in one way or another restraints on trade, particularly tariffs on goods produced in China. And very often in my comment section, I see people say, well, it's good because it will bring manufacturing back home. But of course, we know that there's just so much to that it can be done easily. And it does require significant investment, among other things. But are these economic policy ideas that call for tariffs, let's just say, are they mostly rooted in geopolitical interests or economic interests, such as helping domestic producers?
Oh, it's all geopolitical. Now, if you surveyed economists and you took economists from shall we say the left end of the spectrum, we've got of course Professor Paul Krugman is on the left. He's a Nobel laureate. Writing a regular column, many columns actually in the New York Times. He's very productive. So Professor Krugman made a point the other day, which I totally agree with, and Krugman said if you take all the economists in the United States, if not the world, you could only find maybe a handful that said that there were any benefits associated with protectionism. So here you have, as you know, I was one of President Reagan's economic advisors. So you could say, well, hey, I am a free market economist. And you'd say, I would be I'm actually independent, if you want to. So it's a little bit hard to place me. But I would be in a different position than Professor Krugman, let us say. But we totally agree, like all economists, that protectionism is bad. It slows you down. Why would you want to have the government interfering with transactions between two parties where the buyer and the seller agreed and they said it was beneficial? The seller agrees to sell because he thinks it's a benefit to him, and the buyer agrees to buy because the buyer thinks it's a good deal. So why would the government step in between them and say, no, you can't do that? This is giving power to the politicians and bureaucrats in Washington, D.C., or wherever Beijing, wherever the capital happens to be. And And those people are making the decisions, but they have no skin in the game. If it's a bad decision and it turns into a bust, they suffer no losses. In the profit and loss system, if you have two buyers and sellers, they're both benefiting. This is a good deal. And by the way, if they've made the wrong decision in buying and selling, what happens? They make a loss.
Yep.
So the politicians and bureaucrats, no one spanks them when they make a bad decision. And the geopolitical thing is you put your finger on a very important point. Sanctions, economic sanctions, which the US and Europe are using all the time, by the way. Anything that moves, they put a sanction on it almost. That is a form of protectionism. It's exactly like a tariff. And we're using those with reckless abandon, especially the Biden administration. But it's been good. It's a bipartisan thing. Both parties have been using these sanctions like mad, and this is why generally people are confused about protectionism, because once you get it in your head that putting a sanction on something is good, then, well, why not have a tariff? Isn't that good too? So everyone's thinking is completely out of line with economic thinking, whether it's somebody on Paul Krugman's end of the spectrum or somebody on my end of the spectrum. We're all in full agreement, and the only people that are disagreeing are really a handful of what I would classify as nuts almost.
I couldn't agree with you more. I think it just really drives that gap between countries, and it drives global fragmentation, which is that phrase that the IMF seems to really like nowadays. Definitely doesn't serve consumers or businesses.
Oh no! By the way, just to be clear, people get confused about a tariff on China. Let's just use this example. A lot of politicians talk about, well, we're going to put a tariff on China. Trump has even talked about this way. He says, oh, we're going to make China pay. No, tariffs are imposed on the importer, not the exporter. It's the American who imports something who gets a tariff imposed on them. We don't place tariffs on Beijing or exporters from China. The tariff is collected from Americans.
Maybe one last question for you,
Oh,
Professor.
by the way, on that, you're giving me a lot of ideas, and one is you're reminding me of Hanke's 95% rule, and Hanke's 95% rule is, Lena, 95% of what you read in the press is either wrong or irrelevant.
Yep.
So people reading the press, you have to read the press to see what the spin is on things, but you've got to be very careful about things and stick with the fundamentals.
Yes, and Professor, I think it's getting close to 100% these days in some areas,
Yeah,
unfortunately.
well, yeah, I think you're right.
As you mentioned, the United States is experiencing an economic decline. And as the US economic power appears to be declining, we also see a shift in global centers of power towards multipolarity. The IMF expects the economic growth of China and India to outpace that of the G7 countries, including the United States. And the biggest economy in Europe, Germany, is clearly in decline. It has been in decline for a while due to a variety of reasons, but primarily due to lack of access to cost-effective energy resources and changes in trade policies that don't really serve it well. If these trends continue, where do you expect the US economy to be compared to the so-called global South economies within the next 2 to 5 years?
Well, that's a big question, but I think to summarize, the U.S. will remain you say 2 to 5 years. That's a fairly short period of time. Probably the best dirty shirt in town. So it's got I think a huge number of bad policies, and the biggest bad policy that's officially been adopted, by the way, by the Biden administration about a year and a half ago was industrial policy, where all the big decisions are being made in Washington, D.C. That's the official thing. And of course, you have people making decisions. This is a stupid way to do things that have no skin in the game. If they make a mistake, who pays? Who gives them a spanking? Nobody. In the private sector, if you make a mistake, at the end of the year, it shows up in your accounts as a loss. So we're politicizing more and more decisions. More and more economic decisions are being shifted away from the private sector and private enterprise, where they have an incentive to do what? To provide consumers with what they want at the lowest possible cost so they can make a profit. That's what the whole thing is about. That has nothing to do with Washington. Washington is this geopolitical thing that you've mentioned a couple of times. So I think the U.S. is headed in the wrong direction, and basically it's kind of ironic. Fundamentally, the U.S. is following the industrial policy kind of template of Beijing, of the Communist Party. And Europe, by the way, is doing exactly the same thing. Europe is just in the tank completely. You mentioned Germany, but if you look at the projections for the next 6 years, the IMF projections for Europe, they're just terrible. I mean, they're way below the U.S.
I would love to get your thoughts on that, hopefully soon, because I know our viewers are really interested in trying to sort of understand from a global perspective how the global South and the United States and Europe will coexist, and how the shift that we're seeing right now, what will it transform into? I would love to get your thoughts on that at some point, hopefully when you have time. I know we're getting close to the end of this year, and soon we will start seeing third quarter data. That will be an interesting indicator of what to expect for the full year, and also what to expect from an economic perspective next year. As you mentioned, you expect a downturn, and I think that I think it will be interesting to see what happens within the next several months. Professor, I would love to continue this conversation with you. Thank you so much for joining today, and for such an interesting and insightful conversation.
Well, Lena, it's been a pleasure to be with you, and I look forward to being with you again. We will continue. I think this global South split is, and the geopolitical and economic aspects of it are very important and certainly worth exploring. I look forward to discussing it with you.